Yeah, good morning, viewers. This is Dynamic Trader, your favorite trader. Good day, wherever you're watching from. Today, I'm going to be talking about chart patterns. All right, so I want to educate us on chart patterns, and today's chart pattern will just be on head and shoulders. To start first, when you come to your trading view, or as I'm using derivative trading view, you come to what is this? Pardon me, I'm trying to bring out the tool, the head and shoulders tool, right? So it's also part of the tool you would be using. You can see under patterns. You can see here, when you point to that place, it shows you patterns. So when you click on patterns, you kindly locate head and shoulders. So I'm making it my favorite. So I've clicked on it. So this is head and shoulders. So head and shoulders pattern is simply just like your head, your left arm, and your right arm, how to train with it. So it's a pattern on its own. So you can see this is left arm, this is the head, all right? Then this is the right shoulder. Good. This is head, left shoulder, head, and right shoulder. All right. So, and I can just use this part two to also sketch it myself. This is the left shoulder. This is the head. All right. Why this is the right shoulder. So now, ordinarily, retail traders would always want to take their trade from here, assuming that this place has not been plotted. Let me redo it. So this is the left shoulder. This is the head. The market breaks back to this point. So now, the retail traders would simply come, they will mark out this particular left shoulder. All right, just here. Now, the market is just simply that the market got to this place, resisted. All right, got to that place, resisted, then broke above it, came below it. Now, they what they are going to do is that they will come to this place that the retail traders place their sell limits. Excuse me. Just hold on, please. All right. They'll place their sell limits, their sell limits here, then their TP somewhere around here, depending on their risk to reward ratio. So their stop loss will just be at this particular head, all right, a little bit above or exactly there. Then they will take their trade. The moment the market returns back to this right shoulder, maybe they want to observe a bearish engulfing candle and the rest of them, then they will take their sell to this point. All right. Now, as SMC traders, we don't trade this way. All right. How do we trade head and shoulder pattern? It's very simple and straightforward. How do we trade it? Now, when you see that the market has created this head, left shoulder, head, all right, now it has made the right shoulder, all right, it has made the right shoulder. Let's say it's somewhere here. So retail traders have started, they've started selling at this point, but we, the SMC traders, we don't get involved on this kind of trade. Why? Number one reason is that the risk to reward ratio is not high, as in it's very poor. All right. When I said it's not high, it means that it's poor. That's number one criteria. The number two reason is that the market is likely to do this, do as if it's coming down, then next thing push up to take up the stop losses here. So changing direction of the market. All right. Often at times it happens. So anybody that is trading head and shoulder pattern understands what I'm saying. Sometimes it works. All right. So no, there's no perfect strategy. But as an SMC trader, this is clearly what I would do. I would want to see that the market has created this head as a left shoulder. All right, for instance, the head, then the right shoulder, then breaking the previous swing low created. So this is clearly the left shoulder, the head, the right shoulder. All right. Now, I would want to see that the market has broken the low it created, that's the swing low it created before moving to this, forming this right shoulder. The market has broken it. Then now, my approach to this trade is very simple, as in this very pattern is very simple, which is I would want to enter from the last bullish candle that caused the change of character in this very part, because the market changed character, or you can call it break of market structure at the same time, BMS. So you can call it BMS in this case because it broke the previous swing low created. All right. Then now the advantage is that your stop loss wouldn't be above, won't be at this head. Rather, it would, sorry, what's up here? Excuse me. Your stop loss will no longer be, all right. Your stop loss will no longer be at this head, just like this. No, your stop loss should just be a little bit above the bullish candle that was created, that was formed before this impulsive move to the downside that broke this structural low. All right. So when you've seen this, when you've seen that the market has broken this, you simply come and mark out the last bullish candle. All right. In expectation now this will be your entry. Your entry will be when the market, excuse me, your entry will be when the market returns back to this point. All right. Then you take your sell. Then your targeted profits, your TP area will be here. The previous swing low created. All right. So this is how I trade my my head and shoulder pattern. We have other patterns like we have the double bottom. The double bottom is when the market has created W. All right. This. All right. So for me to get involved on this kind of trade, I'm just trying to deviate. I said I would just want to discuss head and shoulder patterns, but let me just talk about this. So the market has created this W, or before it creates this W, right? Retail traders would want to do what? Buy the moment the market has formed what we call W. So when it has formed this first bottom, all right, when it has first formed this, pulled up, then returned back this way, they would want to buy. All right, they want to buy, maybe targeting the previous high or what. But as an SMC trader, I don't get involved in such trade. So when you see me in action is when the market has broken the previous swing high created, because the market created a high, a low, a high, and a low. So when this swing low breaks above this swing high created before the market dropped on this breakpoint, I mean this, all right? So here, I see here as what? Break of structure, or in this case, change of character. All right. So the market has changed character. So this is where I will fall in. Then I will just come and mark out the last bearish candle, which is the demand zone, the last bearish candle formed. Then I will wait for the market to do what? To return. To return back to this other block or to this demand zone. All right. So this is where I will start buying. So I will place my buy limits here. All right, waiting for the market to return. Then my TP area will be here, this swing high created. Then my stop loss, instead of being here, it will now be very close, very below that red candle, because this is a bearish candle. These are bearish candles that formed before this impulsive move to the upside that changed character. So the last bearish candle that was formed here would now be where below the candle is where my stop loss would be. Then my entry will be at the beginning of that, the opening of that candle, rather. That's where my entry, my buy limit would be. Then I will just take my buy, then target this area as my TP area. So I've been able to explain two chart patterns. This is double bottom. So the reverse of this case is double top. All right. So we have double top, double bottom, head and shoulders. All right. We also have inverse head and shoulders. All right. Inverse. So this is double bottom. All right. I wouldn't want to explain further. But if I want to still explain, it's as simple as ABC. So just take the analysis I made on this, which is the market forming double bottom here. All right. I would want to take the sell from here. Rather, I would want to wait. I would want to wait that for the market to do what? Change character to the downside. But then I will do what? Wait for the return on the supply zone. In this case, there is no longer demand, is supply. Supply is when you're selling to someone. So supply is an area where you sell. So I will wait for the market to come to a what? A premium zone, right? Premium or supply zone. I'm talking about the same thing, or bearish order block. Then I'll take myself from here, targeting this place as my TP area. All right. Targeting this place as my TP area. So that is it. So try to identify this on your chart, and I bet you're going to make money from the forex industry. All right. So see you on the next one. Bye bye.